This week we're going to look at two important developments in markets. One, the rise in bond yields, and we'll spend a brief moment looking at the correction that we've seen in the US dollar. Firstly, the bond yields. You can see the chart in front of you. We're looking at the Australian bond market in red. Yields have backed up over the last 2 or so weeks by about 70 basis points, a little bit less in the US, and quite a sharp bounce in German bond yields, the purple line, rising from about 0.07% as a low to almost 0.6%. So what's been at the cause of this sudden shift in bond markets? Well, probably the key to it has been the lift in oil prices. What we're looking at here is Brent crude prices, that's the blue, and the red is US 5-year implied inflation expectations. So with oil dropping from over $110 to about $47 in the early part of this year, we've seen the move in 2 stages, moving up to around about $66, $67 in recent days, and that coincided pretty much with the lift in implied inflation expectations over the next 5 years in the US, where they've gone from a little bit over 1% to 1.7%. Over that period from early January, as I said, it's been in 2 legs, but over that period from early January, real bond yields have actually been fairly steady. So the move in bond yields seems to be entirely associated with a lift in inflation expectations. The deflationary trades that were in place late last year, early this year, reflecting not only weaker prices for goods and services, but also coming through in oil and dropping European inflation rates into the negative territory, propelled bond yields lower. Now we're seeing a partial reversal of that, driving bond yields higher. When we look at previous bond sell-offs in the Australian market, you can see them shaded here in blue on the chart of the 10-year bond yield. So let's have a look at that in terms of comparing it to previous bond market sell-offs. This is expressed in basis point terms, 0.0 beginning on the X scale, the beginning of the bond sell-off, and of course the Jan 94 was the biggest, up some 420 basis points. The other sell-offs have been are much smaller. The black line, which is sort of hidden, which is the current sell-off, has been about 70 basis points. So it's fairly small in comparison to the worst, but up there and in line with pretty much all other bond sell-offs. If we express that in terms of bond market returns, so looking at the composite index, you can see that the bond market has given up about 2.25%. This was up until yesterday. Again, that compares with in 1994, where the bond market eventually over a 9-month period lost something like 7.5 to 8% return over that period, which was truly an astonishing sell-off in bond markets. So what about the current situation in bonds? And we look at the Australian bond market here. I can just explain, that's the yield in red, 200-day moving averages in pink. Now basically the bond market yield has moved up to around about 3%, which is roughly in line with its 200-day moving average. So it's certainly at a critical point at around about the 3% level. And although not oversold at this point, it's certainly moving in that direction. Very similar picture when we look at the US bond market. We look at the red line being the yield, the pink being the 200-day moving average. So it's moved to roughly in line, maybe slightly above the 200-day. So once again, it's challenging that long-term downtrend that really started, or the current down leg started in the early part of 2014. Now I want to look at the Australian US bond spread, and if we look at that one here now, we can see that what we've done, we've modelled the Australian 10-year differential. Now the model is based on the interest rate differential at the short end, so the forward bill curve, and it also reflects the difference in implied inflation expectations plus a constant. So the purple is the model, the gold is the actual. You can see the actual spread got down to about 35 basis points, whereas the model was suggesting that the differential should be up around about 1%. So what we've seen in recent days with the Australian bond market selling off somewhat, it's moved back up to where the model suggests that it should be. If we start to then bring into our projections or our model, our expectations on inflation and also interest rates over the coming 6 to 12 months, it would suggest that this spread should contract a bit further from where it is at the moment to somewhere around about 60 to 80 basis points. So it suggests that the spread could narrow after this recent sell-off. Finally, I just want to spend a moment or two looking at the US dollar. In terms of this bull market in the US dollar, we're looking at some previous bull markets in the US dollar. As you can see here, the shaded areas. This is basically a trade-weighted index for the US dollar. Looking at that in our event profile, you can see the beginning of the bull markets as we've defined: Jan 79, September 95, and September 2011. So if we extend this out a little bit further, we can see that the previous two strong bull markets in the US dollar ended up in a rise of around about 30% in the 1990s and a rise of more than 50% in the 70s and 80s. So putting the current bull market into context, about halfway through, but it's been somewhat stronger, particularly in the last 6 months. US dollar up around about 30%. What's interesting to note is that around about this stage on each of the previous two bull markets, you did have a correction in the US dollar that lasted probably around about 6 months or a little bit longer. And we seem to be at that point now where interest rate differentials have moved as far as one might expect if we use, say, 5-year spreads between the US and the European markets. And if we consider the growth differential between the two regions has also narrowed. In fact, European growth has surpassed that of the US in the most recent quarter, although both of those conditions we don't think are going to be sustained. So still expecting the US dollar to move up, but subject to a pause, it could last a few more months yet.